Welcome to the What to Watch video update. This video goes through the charts that I'm really focusing on right now, and I make a positive list and a negative list. And I had to be a little bit creative with the positive list because we are clearly going down. Now, one thing I want to explain about the way I analyze the market is when we're going up, I'm looking for reasons why we could be going down. When we're going down, I look for reasons why we could start going up again. I just developed that over the course of years, and it's given me a perspective to plan for the unknown, because that seems to be what really caught me off guard was things that I didn't expect, and they kind of seem to come flying in out of left field. That's why I analyze so many charts. That's why my videos are longer. It's not that I like to talk about a whole lot of different things. It's I want to cover as many bases as possible so that we can see what's happening as it's unfolding and then make decisions based on that. This is being prepared for Monday, August 5th. Before I get into that, I do have a thing called the SPX investing program. It started in June. It's still free. I'm going to be locking it down in August. So feel free to check that out. There is a link below this video that will take you to the website or take you to a list of videos to learn more about the program, or you can email me if you have a question. Also, this is just one video that I do throughout the week. I do a video each day, and that's the real foundation of the analysis and commentary that I do. All these other videos, including this one, are just supplemental. They feed into the daily video. All right, let's go through and look at the positive side of things. And there are some things that we can lean on, but you're going to hear yeah, it's going down, but. So there's going to be a lot of qualifying statements here. Okay, now this is looking fairly good. It's going down, but we're still well above the moving average based on price. We're above the moving average based on volume. That's positive. The negative thing here is that we're going down based on price, and we're going down a lot faster based on volume. We've been seeing this recently where volume has been leading price lower. When we were going up, we saw volume leading price higher, and that's usually a healthy thing. We can't always count on that, but the fact that we're seeing volume going down a lot more right now, that is a concern to us. But the advanced decline lines are holding together for right now. Also, the new highs, new lows, another internal measure of the S&P. Even though we've been going down, we're still showing a lot of new highs and not really much of an expansion of the new lows. We're going sideways with the 5 period, and we're starting to turn back up with the 10. So even if the mega caps are just getting hammered right now, the rest of the S&P is hanging in there for the time being. Also, we are declining, yeah, but we are still above zero here with the advanced decline ratio, both based on 19 periods and 39 periods. Okay, we went down with the cumulative advanced decline line for the NYSE. However, but we're declining with the regular NYSE advanced decline line. However, we are still above an advancing moving average. We also see that here. When we break it down with the common stock, the advanced decline line on the NYSE based on price, there it is coming down. Now, one thing that is a concern, notice how we're going down a lot faster based on volume. We broke out above this previous high based on price. We did not break out based on volume. So there's some positive and negative things here as well. Then looking at this other NYSE advanced decline line, we're coming down, but we're still above the moving average. This is still looking good. The new highs, new lows, this is a daily score. And we are coming down, but we are still positive with this reading overall. Then we take a 50-period moving average of that, and this is continuing to go up. So this is longer term, still looking positive for the time being. The advanced decline line, we are coming down with all of the different indexes, but we are still above the moving averages for the time being. We are coming down with the S&P, but the NYSE advanced decline line is not coming down as fast. Now, these are on different scales, but typically when we see the red line above the bar chart, that's more positive. When we see it below, that gives us a warning sign. Then this is what we're dealing with now. We broke below the 20 a few weeks back, or a week and a half ago. We broke below the 50 on Friday. That was really holding on to some support that we fell below. Now we're down to the 100 period moving average. Can we find a way to bounce up off of this? There are all kinds of moving averages that you can use. I use a 20 for the short term, 50 for the intermediate term, 100 for the intermediate to somewhat long term, and then the 200 period for the long term. That's how I break them down. You might use something different. Then here are all the moving averages to give you some context. Below the 20, we broke below the 50. We're right at the 100. Now, we are going down, but we're still above 50 here with the bullish percent index. This had actually been going up and gave us an extreme reading. These are the point and figure buy signals that are being generated inside of the S&P. And the fact that this was going up was a very good thing until we started to reverse. So we'll be watching this. Are we going to continue to decline and actually drop below 50? Or is this going to be able to recover and go back up? Then we look at the NYSE bullish percent index. This was actually getting to a very high reading. It's coming down now, but coming off of a really positive reading for the broader market. Then we look at the stocks above their 20-period moving averages. This has actually turned negative. We're dropping slightly below 50. The reason why it's on the positive side is we are declining, but still above 50 with the 50-period moving average study, the 100 and the 200. And this is a weekly chart of the S&P. This line goes all the way back to the 1987 crash. We're still well above it, even though we have been declining. And we look at the S&P, which is a weighted index, and compare it with the equal weight. We're coming down with both, but the red line is still above the equal or the S&P weighted index, at least for the time being. You notice when the red line's above, that's when we see some really nice upward moves. Well, maybe this is helping to hold the market together for the time being. Then we look at a different way of analyzing this. When this is going up, that means the mega caps are outperforming. When this is going down, that means the equal weight or the rest of the S&P is actually outperforming. And this has been coming down as the mega caps have been under pressure and the rest of the market's been holding up. We came back up just a little bit. Actually, we came back up and then declined a bit on Friday. The Dow, it did decline. It was down 1.5% on Friday. Seems like, oh, only 1.5% when you look at the other indexes, but we're still above the 50-period moving average. We are coming down, so that's negative, but we have not broken below this support yet. Financial sector coming down, but still at and a little bit above its 50-day moving average. We want the financial sector to be strong. Here's another one, the NASDAQ 100 to Dow ratio. It's coming down, but we're just coming back to these previous readings here with this ratio. Are we going to get a chance to turn and go back up? Now, look at the context of this chart. When this is going down, that means the Dow is outperforming the NASDAQ 100. And we notice that the NASDAQ 100 is under pressure and looking kind of negative right now. If this can turn around and we can see some money coming back in to the mega caps, this will turn this ratio around as well. Then we are coming down. Now, we have to think of the context here. Interest rates going down about 3 trading days ago would have been a wonderful, amazing, awesome thing. But what is the context? Well, we had some weaker than expected economic reports that came out on Thursday, and the employment situation was weaker than expected on Friday. Now bad news is becoming bad news. And are we declining because the market is fearing an economic slowdown, possibly going into a recession? Where before it's like, okay, the economy's kind of slowing down a little bit here. Maybe the Fed will come in and lower rates just to kind of stimulate things. Well, we're kind of shifting right now. Are we going to stay in this scenario that economic weakness is a bad thing and this is going to really put pressure on stocks? Or is the market finally going to go, wait a minute, you know, things are still looking pretty good here. Interest rates are going down. This is a pretty good time. The mega caps have really been falling. I want to go back in and buy some of those things. That's what we're waiting to see will happen. Okay, then we look at the 1 to 3 month, which is pretty much cash. This is a T-bill, and we compare it to 3 to 7 year bonds. Now, we've been wanting this ratio to go down, but not necessarily screaming down like it is right now. Is this because of economic weakness, or are we going to get things under control a little bit here and actually continue to decline, which could be more positive for stocks? Same thing that we're seeing here with the 1 to 3 year compared to the 3 to 7 year. We've been wanting this to go down, but it's going down really quick right now. We don't want it to go up. That means that there's inflation fears and interest rate fears. This going down really fast means there's economic and growth fears that are coming into the market. Then we look at TIPS, Treasury inflation protected securities, compare them with 3 to 7 year bonds. I usually don't show this chart because it doesn't move all that much lately. Well, it's screaming to the downside too. We want it to go down, but not necessarily as fast as it has been. This is that same thing, only going further out with TIPS to 7 to 10 years, also just really screaming to the downside right now. And this is out of fear. This is not necessarily because the market's really happy about things at the present time. This was looking pretty good. Home construction to 3 to 7 years. Bonds, we were going up really nice and coming up out of the rainbow. We've been pulling back, but we still have yet to come back down into the rainbow. Then looking at the broad market, when we look at the 5 period moving average of the highs minus the lows, we're coming down, but we're still above zero. And this is based on the S&P 500, a 10-day average of the highs and the lows, looking extreme positive. It's coming down. It might actually drop here, but it's still giving us a very positive reading as of Friday's close. And again, what's the context? We want the 2 year Treasury yield to go down because often that really gives support in the short and intermediate term to the S&P. Well, it's coming down and we're not seeing much support because the context is possibly changing right now. All right, now, yeah, we've got a pretty long list of negative things here. Sentiment, we dropped below 50 and declining. That's the negative side. We're going down. People are freaking out as of Thursday and Friday. However, we're getting down to this 25 level. If we keep falling, that's when we start to look at this being a contrarian indicator. And when we're in the bigger context of an uptrend, and we might come down here and stay for a little while, but we often don't stay down here for very long. We come down and then bounce right up because the bigger picture is still positive. The VIX just skyrocketed. At one point, it was above 30 in Friday's session. Now it closed below that, but now we're above 20. And this is not a good thing. This just means fear is massively increasing, both with the line chart, which is the closing value, and with the bar chart, which measures the open, high, low, close. We came down off of the high here, but we're still above 20 for the time being. And when the VIX goes up, we also see the VIX of the VIX really start to pick up. That's just showing the VIX is becoming more volatile and gaining speed to the upside. And then here's the Tom Bowley research. We were down here in the 12, 13 area as I was doing these videos. Well, we've screeched above the 20 level, and this is when we start to see negative annualized returns. If we stay up here for very long, that could keep things more negative. The VIX, of course, the momentum as measured by the MACD is just screaming to the upside right now. And we're also screaming a little fast here with the RSI based on 9 periods. We're getting extreme. So maybe this is due for a little bit of calming down time. And this is another way that I measure sentiment is risk on. Folks are willing to throw their money into stocks that usually do well when we're going up, but also do pretty bad when we're going down. And then versus risk off, where they don't get into the high beta stocks, they get into the more conservative stocks that tend to hold up better when we're going through a decline. We're really seeing this coming down. We've been range bound for all of 2024. We broke below this range as we're seeing some pretty significant weakness right now as folks are going more risk off. All right, large cap growth. This is where it's been in 2024, but we're coming down. Notice how this was a support level that we bounced up off of. We're right at that level right now. We came down below it, but we're still right above it. This is the 100 period moving average for the large caps. Are we going to be able to bounce up off of this? We haven't necessarily closed below it yet. And then we look at the ratio between the large caps and the small caps. This was really coming down as everybody was just oohing and eyeing over small caps. Well, now the small caps are under some weakness, and so this ratio is starting to go back up. We want to keep an eye on oil because it's just continuing to drop, and yet there's the potential of escalation of things in the Middle East, Iran and Israel, okay? And it's like, what? We're not going to do anything here. We're not even paying attention. Well, at some point, folks in the oil market may start paying attention to this, especially if Iran actually attacks Israel. And then if the U.S. gets involved somehow, and we'll just have to see. Is this going to get bigger? We don't know yet. There's been some things that have happened, but we'll just have to watch and see where we go from here. Because oil going up can be positive for the market. You know, when oil companies are making money and they're having nice profits and that helps the stock market go up, that's one thing. But when oil goes up because of geopolitical events, that's a different story and that can actually have a negative impact on stocks. But the fact that we were above 80 and then we dropped down here, we closed at 73, and yet there's all this tension in the Middle East right now. Eh, we want to just keep an eye on this for the time being to see if anything does develop in this market. And then this is not positive or negative, it's more weird. Where when I show you charts later on, this is the parabolic SAR on the SPY, which is the ETF for the S&P 500. We're negative with the S&P, both on the daily chart and the weekly chart that I'll show you later on. But look at this. We actually switched over to positive on Thursday. And even though we went down, we're still positive. When the dots are underneath, that means this is positive. Now, the dot, and we don't see this very often either. We just saw one dot below on Thursday for the S&P, and then boom, it went back above on Friday. Usually these dots hang out in these areas. Here's a 2-dayer right here, but usually it's longer than this. And so we'll have to see, is this going to adjust? And price is even below the dot, but yet it's still positive. Okay, so maybe I'm just misreading this. Maybe this is actually negative because we're actually going down with price. We'll just have to see this thing kind of figure itself out right now. Okay, and we want to look intraday at large cap growth versus large cap value. The red line is above the blue line. They both have been under pressure, but the red line's on top, and that's been not really good for growth stocks. Here's the S&P growth to value ratio. Been declining going back to about the early to even middle part of July, where we've been just seeing this trailing down on an intraday basis. Small cap end of day chart, ticking back up, but just not looking strong right now. Actually going down with mid cap growth to value, going down with S&P growth to value. This is not helping things right now. This could be interesting. When we look at the growth ETF and the value ETF and do a ratio, notice how we came down to this 250 period moving average and then bounced up off of that really nicely back in April, back in the good old days when the market was going up. Well, we came down to the 250-day moving average and we're still above it and we're kind of gyrating around a little bit. But if we can bounce up off of this, that could be a potential positive sign for the market. But right now it's negative because we're down and we're close to the underside of the rainbow. Discretionary versus staples, it's going down. That's negative. And now we're starting to see more of a pickup in the trend. This is the short-term trend with the ADX. It's starting to cross above the moving average, which means this could be a strengthening trend in the short term. The red line's on top and it's going up. So that is negative. We're seeing that also. The ADX is starting to turn back up with the red line on top. This also is suggesting the intermediate term trend is turning negative. Accumulation distribution, we're negative. We're below a declining moving average. However, with the boom indicator here, we're getting extreme negative at this point. Could this be a support level? This is a smart money indicator. Another smart money indicator is the chicken money flow, which is negative, but maybe a little too negative here. We're getting a very low reading on this, which may have the smart money come in and want to do some buying. And we're actually going up a little bit with the Chaikin oscillator. Even with Friday's decline, we had become extreme negative and we're starting to go back up slightly. This could be somewhat positive, even though it's still negative. We have to treat it that way for the time being. The vortex is negative with the red line on top, and the red line's going up as the green line's going down. The condition of the 20-period trend here, not looking good. We've got the green line and the blue line going down and prices below. So yeah, we're negative in the short term. We're also seeing a deterioration here of our 50-period moving average study. We're below both the lines and the red line's starting to go down faster than the blue line. So we're seeing weakness here as well. And we're going down with the 20, 50, and 200-period moving averages just based on the S&P itself. And I haven't shown this chart before because there wasn't really any need to. This implements a thing called anchored moving averages, which are different than regular moving averages. If you have a 10-period moving average, and it's simple moving average, you just add up all 10 periods and divide by 10 to get the average price. Then the next day, the 11th day comes on and the first day falls off the calculation, and then it draws a line over a period of time. This is a different approach to moving averages where you anchor it to either a high or a low, and then it just goes shooting off into the future. Well, I really couldn't do much with this chart for a long time because we just kept going up, because this pretty much helps us when we're going down. Well, that's kind of what's happening right now. So I drew a low here back in April and then another low, I think Mayish or so. We broke below that. That's the orange line. And we're starting to go below the anchored moving average with this low that we set back in April. If we continue to fall, we'll be watching these purple areas as well. And then the rate of change going back 20 periods, we're going down. That's negative, but we're dropping below this green line. Now, I put the green line on here just as a reference point because a lot of times when we get to this level, it doesn't necessarily mean we're going to reverse. It just means we might finally start to slow down. And you can see when this happened back in April, we actually bottomed with this a little bit before price bottomed, and this started to stabilize and go back up before price started to go back up. So maybe this is giving us a little bit of a heads up. Then the S&P McClellan oscillator, we're dropping below zero. That's negative. So we were seeing a negative divergence here where price was going up and volume was going down. Well, now volume's still going down, but price is starting to roll over as well. We're seeing a similar thing here with the NYSE McClellan oscillator dropping below zero. So we're starting to roll over based on price and volume with the summation index. And we're seeing a negative kind of mixed picture here. Based on price, the Swenlin trading oscillator, it's still above zero, but declining, where we're below zero here based on volume. This is another one of those things that's showing that volume is leading price lower right now. Here is the parabolic SAR, where we had one dot underneath that was turning positive on Thursday. And because we had that up open, and even though we closed down, and it was quite a down day, that still put a dot there. Well, then after Friday, when we opened much lower, it put the dot on top up here. Here's the weekly chart. We've been negative now for the last 2 weeks with the parabolic SAR, and I treat this as a primary indicator. We are negative when we look at momentum in the short, intermediate, and long term. We could be getting a little extreme with the slope oscillator. That's a potential area where we might see a bit of a turn up. However, when we look at our other short-term oscillator, the TSI, we're just dropping below the midpoint. We could still have room to go to the downside here. We're also seeing more weakness across the board in the intermediate term and long term. The boom indicator, we're already extreme negative. That means that we're far away from the 20-period moving average, maybe a little too far away, and due for a bounce back up towards the 20-period moving average. Also, in the intermediate term, we're dropping below zero. We're actually going from positive down to being negative. We're still positive with the 200, though. We are declining, but above zero. The mass index, this is a crazy chart that only comes up every once in a while. This is actually a three-part signal, and we don't know what it's going to be until the signal is actually generated. When we get above the red dashed line, that's signal number one. Then we get above the blue line, that's signal number two. When this rolls over and comes back down to the red dashed line, that's the third signal. Whatever the market is doing at that time, this indicator suggests that there'll be a reversal. So if we're going up, it's looking for things to go down. If we're going down, it's looking for things to go up. It hasn't completed all of its signals yet, so we don't really know what it's going to be. We can guess because we've been going down as this has been going up here. So yeah, it might be trying to figure out that we might be at some kind of a bottom. If you look at this, other times that these were generated, okay, we had a nice little bump up there, but then it just fell down. Other times we got a signal here and it ended up just not really turning into much. Then other times it actually gives us a fairly decent signal. So I don't rely on just one indicator. That's why I take a lot of things together to reach a consensus about it. Looking at the advanced decline line on a cumulative basis for the S&P is coming down. We're coming down based on price. We're going down faster based on volume. That's another concern. The NASDAQ is below its 50-day moving average and closed slightly below this pivot point. And here is the NASDAQ 100. And I tried to point this out, and I don't want to, oh, look at, I told you so. When I said, okay, be aware of this candle right here where we opened, we had a high, a low, and then we closed just about in the middle. That's like a doji and candlestick think. Well, And then we started coming down after that. Well, I'm not trying to be, all knowing here, because we saw a couple of other dojis here and we just kept going up. So, but this is definitely turning more negative right now. The Qs here, also the NASDAQ 100, we fell below the 20 period moving average. We left the 50 period in the dust. We're coming down here. I don't have a 100 period on here, but we need to see a little bit more of a bounce up here to try to get this thing turned around more positive. And then looking at the NASDAQ 100 bullish percent index, we tried to make a little bit of a bounce here, never got back above 50 or never turned positive, and now we are continuing to decline. The NASDAQ 100, we're right at this pivot point now for S1. We're below the 50-day moving average. Is this going to be a support level that possibly the NASDAQ 100 can use? And we're also looking negative with the momentum as measured by the PPO, but we're possibly looking a little too negative here. Maybe we're going down a little too far too fast, and this could suggest some potential exhaustion. We don't know that yet. We're just getting down to some very low readings, where other times, sometimes this ends up being some kind of a bottom. Small caps, a week ago, everybody was all in love with them. They couldn't sell them fast enough this week. We really gave a lot of that back. But if you watch the deep dive video, it's the small cap index that's the strongest right now. And in second place is the S&P. They're all really underwater and not giving us good scores on a scale of 0 to 100. But the small caps are hanging in there the best. We're still above the 50-day moving average, but we just gave a lot of that back. And now we're coming back into the range that we couldn't seem to break out of earlier in 2024. And when we look at the Russell 2000 small caps, we're dropping below 50 with the RSI. We're still a little bit above the 50 here. So this is still hanging in there for the time being. But in the short term, the momentum continues, or is now starting to turn negative. We look at the ratio between the small caps and the S&P. It had really started to go up as small caps were beginning to outperform, even though in the bigger context of things, small caps were still negative. Well, now this ratio is starting to come back down. The mid caps dropped a little bit below this pivot point, and also they dropped down below their 50-day moving average, a little bit above this other pivot point. Earlier in 2024, this was the strongest index coming out of January and throughout times in the spring. This index was, way back here. See how this was just going up really nice? Well, we've been chopping sideways. We tried to break out, and now it's giving back those gains. This is another one, the Qs. This is the NASDAQ 100 to the small caps. We had been really coming down. This is one of the charts that the perma bears just think is the holy grail to 80% declines in the market. Well, we were coming down with this ratio, but now it's starting to go back up as the small caps have been under pressure. The Wilshire, this was one of those areas we were hanging on to this for hope. We were camped out along the 50-day moving average, possibly building a base, possibly looking to launch up out of here. No, we fell off a cliff. Now we're below the 50-day moving average, even though the longer-term trend is still positive. Another broad market measure, the total U.S. stock ETF, we were staying above or at the 50-day moving average. We've now fallen below that. And here's the Staples to tech ratio, and this is going down. That means tech is outperforming. Well, we saw Staples really bouncing back up here. And in fact, it's breaking above the 200-day moving average. This is more defensive when the market is more concerned and possibly turning negative. The dollar is going down, but that's not giving any support to stocks right now, even though the trend is still positive. And the FANG index could not get back above the 50-day moving average. It got there, it got above it intraday, only to close down below it, and then we're seeing some weakness here now. And we look at the S&P 1500, a very broad market measure, and compare it with short-term 1 to 3 year bonds. We were doing really well here. Well, now we're coming back into the rainbow, and you're going to see a lot of this in the charts after this. This is another broad market measure with further out bonds coming back into the rainbow, turning more negative. The tech sector to the 3 to 7 year bonds, we're coming down to the 250 period moving average with this rainbow. Are we going to find some support right around here, or are we going to continue to fall below this? This is also a potential shift that we're seeing. When this was going up, that means folks were preferring junk bonds over more conservative and safer bonds because they were getting a higher yield. They were willing to assume that risk. Well, those days seem to be over right now as we're dropping below the rainbow. Now, another thing could be happening is that folks could be getting out of junk bonds and getting into longer term safe government bonds because they think interest rates have topped out. So there's a couple of different scenarios that could be playing out here. Then looking at 3 to 7 year bonds and comparing them with stocks, we wanted this to continue to go down, but now it's starting to go back up as bond prices are actually outperforming stock prices over the last few sessions. Here's a weekly chart of the NASDAQ 100. We're dropping just a little bit below this long-term trend line going back to 2009, but we've dropped below it before. Doesn't necessarily mean the end of the world, but we just want to be aware of this. And we look at the Qs and compare it to 3 to 7 year bonds. The Qs had been really outperforming. Now we're coming back into the rainbow. And we look at this soft landing versus hard landing. The market was just totally convinced we were going to have a soft landing, which means we were not going to go into a recession. A lot of thought has changed on that now with the employment situation report being weaker. And now we're starting to come back into the rainbow. Are we going to stop at some point here and go back up, or is this going to continue to fall? That's what we'll be waiting to see. And we look at the Eurozone. These are stocks in Europe and compare them with American bonds. This is actually dropping below the rainbow, and they're having their own problems in Europe these days, other than the Olympics. Yes. This is another chart. I haven't talked about this in this video. This is the 3-month yield, and we want to keep an eye on this because look at what happened back in 2007. We were at actually a little bit lower than where we're at right now. And then this thing started to fall apart, and this is the great financial crisis. We don't know if things are falling apart here, but this really has started to roll over and go down. And we just want to pay attention to this. And we're not seeing really any help now with our growth to value ratios. The Qs to S&P going down, discretionary to S&P, and large cap growth is underperforming large cap value. And we're going down with the large caps, mid caps, and small caps ticked up, but they're still below a declining moving average. The S&P to utilities ratio is going down. We want this to go up to be more positive. And this is a mixed picture here. When we look at the advanced decline ratio based on price, we're still above 0. Based on volume, we have dropped below 0. Again, another negative divergence suggesting volume is leading price lower. This is also going back up. We want it to go down. This is the staples to S&P ratio. And this is a longer term chart that was on the positive side for a long time here. But we came back and closed down below this R2 level here. This is a weekly chart of the S&P. We gave up that support level. And it's the Ichimoku cloud. I also call it the itchy and scratchy cloud. I had been showing this in the daily videos because the blue line had already crossed below the red line, which was turning things more negative, and the green line was starting to come down. Another reason for showing this is we've now come into the cloud. Send in the cloud. Sometimes we see this as offering an area of support, and we haven't fallen through it, at least yet, anyway. And then we look at semiconductors to the Dow. This ratio had really been going up as semis are under pressure. Now this ratio is going down. And we want to keep an eye on utilities. And there's a couple of scenarios we can go with here. Are utilities going up because they're more defensive? Because this is what folks get into when they're afraid that the market's going to start falling apart. Look at how we went up in 2021. And utilities actually held up better. I mean, they had their declines too, but they're going back up again. That's more of a defensive posture. Another scenario could be that there's just more demand for utilities right now. Interest rates are going down, and that helps utilities. And we need a lot of utilities these days for AI and for Bitcoin and crypto mining and all those things. That's why these are going up. We don't know if this is more of a defensive play or if it's actually more of an aggressive play. We want to keep an eye on staples too. This is really in a solid uptrend and actually breaking out right now. This is also a defensive move. And healthcare, because you have to have healthcare no matter what's going on economically. This actually, it was down on Friday, but this has been holding up quite well. We look at another ratio between small caps and tech. When this is going down, that just meant tech was outperforming. We started to see small caps bounce back up, but now they're starting to pull back. All right, and do we have a Hindenburg omen? No, not yet. Now, August 2nd was the cutoff day, but we're not going to get August 2nd's chart until after August 5th when the market closes. There's a one-day business day lag with this chart. Now, you talk to the perma bears. Now, I haven't been able to listen to any of that, and I don't. I read a few headlines, but I usually don't watch their stuff. I'm too busy doing my own stuff. They've already declared this is a real thing, and this is really, oh boy, we're excited. What a terrible way to live your life. My gosh, you're going to be wrong 70% of the time anyway, because the markets usually go up 70%, and we do have 30%. They just live for that 30%. Anyway, if on Monday, if we get another spike up, that will be for Friday's session, then we have a confirmation here. But as of right now, we don't. And we do have a confirmation for the NASDAQ, but we had lots of confirmations for the NASDAQ in 2024, only to see the NASDAQ continue to go up. So I don't use this in isolation. I use a lot of different signals together to reach a consensus while still respecting all of them at the same time. That's my approach. Thank you. I really hope you're having a wonderful weekend, and I will talk to you in the next video.